I'm leaking everything I know about becoming a profitable and consistent trader because I honestly hate where the trading space is at right now. Everyone's selling you this dream of getting rich quick, flexing their lifestyle, and giving out the most BS trading advice of all time and slapping a $1,000 ticket on it. None of them are giving out the high-level stuff that actually takes a trader from inconsistent, blowing accounts to a consistent trader who gets payouts predictably. So in this video, I'm leaking everything. My core philosophy on trading, my psychology, my strategy, how I journal, and my entire repeatable system. Literally all the stuff I had to learn on my own over the 5 years of losses, blown accounts, thousands of dollars, and I'm giving it to you for free. And my promise to you, if you can actually sit down, take notes, and apply what I'm gonna tell you, it will change everything for you. Let's get into it. All right, this is the exact framework I use to find my daily bias every single day. Now, first, before I get into daily bias and anything like that, you do not need a daily bias every single day, right? I'm just gonna put it out there. You need overall discretion in the market. You need overall conditional awareness in the market, but a bias helps that, right? You need to know these things to have a bias. You need to have a bias to know these things, right? So if people tell you online, oh, you don't need a bias, that is just BS, it's also a little bit of BS, because how do you know where your draws are? How do you know, where to take the trade in order to deliver from this gap? That you need conditional awareness, and you need a bias, and you need discretion. Just putting it out there. So let's get into it. So first thing, it comes down to two questions, right? Which fair value gaps are we respecting, and which are we disrespecting? Respecting bullish gaps and disrespecting bearish gaps means bullish, flip it for bearish, vice versa, right? Which swing high or low are we drawing toward? Mark the level price is pushing into. That is your liquidity target for the day. When we talk about draws and liquidity, session highs, session lows, equal highs, equal lows, session sweeps, right? Liquidity sweeps, overall gap fills, like all these things that you need to understand that are draws and liquidity are really, really going to help you, because that is the ultimate thing you need to know. If you don't have a bias, if you don't have any higher time frame awareness, you need to know, where are our draws, up or down, right? Where exactly are they? All right. Now, bullish bias, read it in one look, right? Price respects the bullish gap, disrespects the bearish gap, then draws toward the swing high. For example, draw on liquidity was the target. Let's say it was London high or a 15-minute gap fill, right? We disrespect the bearish fair value gap on the higher time frame, right? Meaning we are most likely going to draw towards the bullish area where the session high was, or the draw on liquidity, right? We are respecting bullish gaps, disrespecting bearish gaps. That means we are going to continue bullish, and vice versa, right? So let's pull up the charts. So right here, right? This is last night. Right here, overnight, we had a little bit of a chop range, but what do I see here? Now, first, let's mark out our gaps. So this is the 4-hour time frame. You always need to be looking at the higher time frame as well. We have a 4-hour bullish fair value gap, right? Sorry, bearish fair value gap. Are we respecting it? No, because if we were respecting it, we would be coming into it and then coming back down, because those are sell orders inside of a bearish fair value gap. But what did we do? We closed above. And that's something you can tell if we were disrespecting a gap. If we close above or below, it depends on what type of gap it is, right? So first of all, before the session even ended in Asia, we closed above a bearish fair value gap on the 4-hour. So what does that tell me? We are disrespecting it. So we came back down. Okay, that doesn't mean anything. We still are disrespecting it, because we still can go, we can fill it and then go up, blah, blah, blah. But what is our draw on liquidity? So one thing we are disrespecting this bearish fair value gap in the 4-hour, which means that we're disrespecting many more fair value gaps on the lower time frames. We go to the 2-hour, we go to the 1-hour, 30-minute, all these things. Those are more bearish fair value gaps right here. Let me show you an example, right? This is one on the 2-hour, but on the 1-hour, we have a couple more. If we go down to the lower time frames, we are going to get even more, right? Just minimal bearish fair value gaps that we are disrespecting, right? Even right here, right? So I like to chart on the 4-hour when I'm looking for my overall conditions and daily bias. But more importantly, what is our target, right? Our target is this 4-hour high. Okay, that is one draw on liquidity. Also, another 4-hour bearish gap, right? Either come into it or fill it in the session, right? This high, and then this bearish fair value gap as well. Okay. But our ultimate target was this high. Okay. So I don't even know what happened in this day, right? So I'm going to take you through it. Now, you don't just go on the higher time frames and find your bias and go, okay, we're going up for the day. No, right? Let's scale down to the lower time frames. Let's look at our overnight session, taking out these gaps. Okay, so obviously we are bullish from yesterday. Previous day low is a nice target. We already are in a bullish trend from these lows on the 15-minute time frame. Obviously, we have a little bit of a bullish trend here. So that's a first tell, right? If we are going to be bullish or bearish, sorry, I would want to come take this low out with taking one of these gaps out as well, right? Or at least tapping into them. Okay, so Asia and London here. How can I tell? First of all, I like to use the fib for my OTEs. Okay, so I draw that out too. What are we in here? We are in the golden pocket for longs, right? So first off, okay, that tells me we're in longs. Another thing, now that's 3 or 4 things we have telling us that we're going long. So let's see what happens, as well as finding other confluences in the lower time frames. So that is the OTE version of where I find my bias. Now let's go to the lower time frames. Now, what do we have? Mostly on the 15-minute, I look for gaps because you're not really gonna, come all the way up to these 4-hour gaps until you take a trade, right? You need a little bit clearer targets to kind of go off of when market opens. So first of all, we have this bearish 15-minute, right? We have these wicks up here, Asia high, okay, London high. So we have 1, 2, 3, 4 targets on the lower time frame in order for us to hit. So that would tell me, okay, how do I execute this if I have a bullish bias? Let's see what happens in the morning. So right now in this replay mode, we're at about 9:15. So market's about to open. Let's see what happens. Let's go down to the 5-minute time frame. So obviously we have our draws and liquidity to the upside. We are delivering from 4-hour gaps, and now that's something I want to go over as well. Going back to the 4-hour time frame, what are we delivering from? Okay, we are delivering from this 4-hour rejection block right here. We are delivering from inversing that 4-hour bearish fair value gap here and here. And we overall have a bullish bias. So going down to the lower time frames as well, you can see that we are in this OTE zone more importantly, right? An OTE zone tells us that it is rebalancing volume, a retracement in order for a bigger return, right? In order for these OTEs to kind of play out, we need to retake our range highs. Now going back to the higher time frame, usually on this day we didn't, and I was kind of looking for that for this example, but usually we are delivering from some sort of higher time frame gap, right? Whether that's a daily gap, a weekly gap, whatever it is. Like for example, right here, I was bullish in this point right here because we successfully filled this daily bullish gap, okay? So not only are we inversing 4-hour bearish gaps here, you can also find a bullish bias or vice versa with when we deliver from a higher time frame gap, daily, 4-hour, 1 hour, whatever it is. So let's go back and see how it plays out with my kind of bias structure. So I would be looking for longs here. 1, let's go over it. OTE of the whole entire range in overnight session. Draws and liquidity to the upside, session highs and higher time frame gaps. 15-minute gap here, 4-hour gap up there like I showed you guys, as well as these highs right here that were the short-term targets, as well as this 15-minute. So let's see how it plays out. If my bias would be correct, so I'd be long here. Obviously, this isn't an entry model or anything, but you would need confirmation, but this is just a daily bias video. Let's see if we take over this zone being bullish on the day. Boom. Okay, so what do? We took out not only this 15-minute, London high, Asia high, that previous high that I drew out from that day, and we're going towards this 4-hour gap. So let's see if it played out. Boom, right? So not only did we take our intermediate levels here, we also took our higher time frame level there. So I knew that going over it again. 1, I had some confluence from my OTE zone. I had some confluence from delivering from a bullish trend overall in the higher time frame, right? We inversed a 4-hour gap over here, right? We are targeting another 4-hour gap. We are targeting London high, Asia high, this day's high, last Thursday's high. And overall, I had a discretion in where we are going because that is what comes with experience. And that's the most important thing, right? You can have all of these technical things on the chart, but if you don't know how to react to conditions, then you won't fully get it. So make sure you have those chart hours. Make sure you know what you are doing with that and follow your rules. Okay. Other than that, that is pretty much how I find my daily bias. And you can go back to these kind of frameworks right here, but moral of the story, trust yourself, trust your judgment, and you need to know how to react to these market conditions. Because if you don't have a daily bias, if you don't have anything, if you don't have levels, you need to have that discretion and experience. All right, so what are my confluences that I use every single day when I trade? Okay, we have fair value gaps. Yes, I use fair value gaps. Yes, I use inverse fair value gaps. I use rejection blocks. I use SMT divergences, and I use CISDs. There's a couple more, but these are the main ones that I use, and I want you guys to know very, very well because you see them every single day. So let's go through them literally one by one. So first, we have a fair value gap, okay? Fair value gap is basically the gap between the first wick, the second body, and the third wick. Wherever we're going, if we're in a bullish trend, it would be a bullish fair value gap, the gap between wick, and the body in between it. Now, if this wick was up here, the gap would be only right here. I'll show you on the chart. But this is a bullish example and vice versa for a bearish. Second one, we have IFVGs, okay? So basically what an IFVG is flipped, okay? Let me pull my face in here. So with an IFVG, we disrespect a fair value gap. In this case, if this was a bullish fair value gap right here, we would have to close below this bullish fair value gap in the same time frame that it created itself. That is very important. You have to have the same time frame that we created. Let's say this is a 1 minute fair value gap right here, right? If we close below this on the 30-second time frame, that is not valid. We need to close below it on the 1 minute, the same time frame that it created itself, right? And obviously continuation down. Third, we would go into rejection blocks. Now I use rejection blocks for more of my high RR trades and more of my top tick and bottom tick type trades, okay? So first thing you need, right? You need to sweep liquidity and you need to create a big wick, whether it's bullish or bearish, okay? And then what we do, we retrace back into that wick. And I'm going to show you an example in the chart after, but I also use rejection blocks a lot for confirmations on my entries as well. If I do miss maybe an OTE, top tick or bottom tick, I wait for the rejection block retracement. Fourth, what else? We have SMT divergences. So with SMTs, okay, we always chart it with ES because those are the correlating assets we use, and I most of the time only trade NQ, okay? So basically, if NQ sweeps a high or a low, right, in this case, NQ sweeps the low, if ES sweeps the low and NQ doesn't, right? So basically we have a key level right here, NQ doesn't get below it, ES gets below it, vice versa. If we have a low here or a key level right here, NQ sweeps it, but not ES, we trigger a high chance of reversing, okay? That is what an SMT divergence is. Now going on to CISDs. So with a change in state of delivery, right, that is what it's called, CISD, change in state of delivery. We make a range, right? We make a higher, 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 low, whatever it is. The first candle of the move, for example, this is a higher high, this is the higher low. We're still in a bullish trend, but if we change the state of delivery, right? Sorry, we're still in a bearish trend, lower high, lower low, and we close above the candle that created that other lower low, the manipulation leg that created that lower low, we have a high chance of continuing in that area because we closed above, the body closed above. Remember that the body closes above the first candle of the move of that lower low move in this example. Okay, so let's go through some examples on the charts. First thing I want to go through, let's go through fair value gaps, okay? All right, random fair value gaps, let's go here. First thing, is it a bullish or bearish fair value gap? Okay, where are we going in price? We are going up. So this is a bullish fair value gap. Now, what is a fair value gap? Fair value gap is basically an imbalance of orders. In this case, it is an imbalance of buy orders But basically, what's in a fair value gap? It is resting orders. It's liquidity. It is just orders resting in the market waiting to get stopped or filled. Inside of this gap here, because we imbalance, that's why we created a gap in price where there's no wicks. Now, how do we use them? To put it quickly, this is very simple. You should know this, right? We want to retrace back into those gaps, refill back in those gaps, and there's 3 ways you could do it, right? In this case, we made a move higher, created this bullish gap on the 5-minute time frame. We come down, we tap the gap, and then we have a reaction back up. So that is a correct way to respect a bullish fair value gap. Vice versa with a bearish. So let's give a bearish example. Let me find a bearish example. Okay. Random bearish example. Okay, we can use this one right next to it. So bearish 5-minute fair value gap right here. It is bearish because we were in a downtrend and it got created with bearish candles. Won't let me type on there for some odd reason. Okay. Bearish fair value gap. So bearish fair value gap, like I said, there's 3 ways you can do it, right? Made a bearish fair value gap with an imbalance of orders to the downside. What we want to do to respect it, we want to come back, fill it, tap it, or hit the midpoint, and then come back down, right? And create a new low. So this is an example of a respected bearish fair value gap. Made a move lower, created that bearish gap, came back, refilled it, retested, and then made a move lower. So going back to the 3 ways you could use it, okay? We could use it on a retap, like this example, a refill, a retracement to fill the bearish fair value gap, and then we could also hit the midpoint of it, right? And then react off of that, the 0.5 of the consequent encroachment, the CE of it, whatever you want to call it, okay? So tap, midpoint, fill. The highest probability is when it fills and reacts, just like this. That is why we have such a strong move down. Now, also with higher time frame gaps, notice this. The taps are more probable to happen because higher time frame gaps, there's a wide range of the gap. For example, this gap right here on the 5-minute time frame is only 63 points. Now, if we go, for example, on like a 4-hour gap, it's going to be what? 200, 300 points maybe, right? Depends on the move. So that's why taps on 4-hour, 1-hour, stuff like that, usually present themselves more. Midpoints as well as the higher time frames, and then fills usually on the lower time frames like 5, 3, 2, 1, whatever it is. So that's simple, right? Fair value gaps. Now, next, what do we got? We got IFVGs. So basically, what is an IFVG? Let's see a good example of one right here. We can go to a market open day. Not that day, definitely not that day. Let's just find a random example here. Crazy price action lately. But let's go down to the 1 minute. Show a better example, a little bit more clear. That's not the day I was looking for. All right. This is an example of a trade like I actually would have taken, right? So IFVG, think about it as this. We have a fair value gap, right? Whatever it is, bullish or bearish. Let's say bullish fair value. Okay. Price needs to obviously create it, right? And then we sweep a level, right? Sweep a key level of liquidity up here. And then what do we need to respect it? We need to come in and react, either tap, midpoint, or fill, and react to the upside because it's a bullish fair value gap. If we're respecting it, we should use it as leverage to go back to the point where the continuation where it was going. But IFVGs, in simple terms, are disrespected fair value gaps. So think about it like this. If we create that fair value gap and we want to respect it, we will probably have a lot of strength if we respect it and keep going, right? But we have even more strength if we say, okay, I don't care about your buy orders here. I'm going to keep going down and close below this bearish fair value gap. Bullish fair value gap. So if we're in a bullish trend and we create a bullish fair value gap, and then we come down, we tap into it, midpoint, fill it, and we still keep going down, how strong do you think the downside is? It is a lot stronger because it's stronger than the bullish orders right here. So that is why an IFVG is a thing overall. Now, this is an example, right? We sweep London high right here, okay? My bias is bearish after that, and I look for a IFVG. So what do we have on the higher time frames, right? I need to find the highest time frame possible in my setup for the IFVG. That's very important. And now on my strategy video, you guys will hear me yap about that for a minute too. So in this case, the highest time frame IFVG or gap we found was, or IFVG, was a 1 minute gap, 1 minute bullish gap. So what do we need to inverse it? We need it to close below on the same time frame. So what do we do here? Let's go to replay mode. We still haven't closed below. Again, the bodies have to close below in order to disrespect the fair value gap. So let's see what it does and wait till it closes below. Okay, so this was the first candle that closed below. Let's go back 1 second. This was the first candle that closed below. So it disrespected all of this liquidity right here inside of that bullish fair value gap, and we closed below. So I'm going to be taking a short there, where my stop would be, targeting our draws on liquidity. Near low, blah, 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 whatever it is, right? So this is how it plays out. Notice how the only candle that closed below triggered that dump. So that's very important when we're talking about IFVGs. So that's the simple terms on what an IFVG is. It's basically a disrespected fair value gap. On a bearish example, right? If this was a bearish fair value gap, okay? We created it on the way down, okay? So what we need is, instead of reacting to it to the downside, we need to react to and close above, or not react to it and close above, so we have more strength to go to the upside. Makes sense? Okay, let's delete this stuff. And that's just simple terms. Once I get my strategy videos on here, you guys will see in live action. So next is a rejection block. So let's go to a good example of a rejection block. I think I had one with the trade I took the other night. Let's see when that was. Let's go to the 5-minute time frame so we don't have to wait all this long. Okay. Okay, I can find one right here. So first thing we need, right? We need a move to the downside, obviously, right? Okay, this is not the best example possible. Let's go to another trade I took with a rejection block. Okay, so with a rejection block, what do we need? We need price wicking into a key level, right? Sweeping this high or tapping into another fair value gap or whatever it is. And then we need a strong reversal off of that. So we create a wick, right? We wick it out here, okay? And this is our rejection block right here, the box I'm using. So we swept the key level, this high here, high day, and a previous gap over there. So we're delivering from that. Then we make a big move down. So that shows that there was a bunch of stopped orders over here, right? Buy orders that just got stopped. Now we mark that out, okay? Make sure you mark it out precisely with your box here because it shows the midline. Now in this case, we didn't use the midline, but what I would be using, right? I would wait for it to make the move down, blah, blah, blah. Did not hit our draws, which were right here. It retraces, enters this rejection block right here. I take a short off of that, stops above the wick on the same time frame or on the lower time frame, and then targeting our draw, right? That is a 1 to 14 risk to reward. So rejection block, we sweep a key level, fill a gap, tap a gap, whatever it is, have some sort of liquidity that's being swept, create a reversal off of that, create a big wick. But the biggest thing is, it has to be inside of a confluence. Now, if we mark out our level here, so lining up with that same line that we wicked out, what did we do? We tapped inside of this 5-minute fair value gap. Some sort of PD array, right? We need to be delivering from. Okay, that's very, very important when we go over these rejection blocks. So what do? We wait till it retraces back into the rejection block, set our limit order either at the tap or the midpoint, and then we target our draws that were unswept right here. That is a 1 to 14.2 risk reward. Okay, let's go into our next. Okay, SMT divergences, right? We need to understand that it's very, very simple to see a SMT divergence. All it is do we have NQ sweeping a low where ES doesn't? Do we have ES sweeping a low or high that NQ doesn't? This is an example right here, okay? NQ was lower, with this wick than that wick. Let's go to ES. ES was lower with the first wick, not the second wick. So this low was not swept. This low was swept. That is called an S&P divergence, and that triggers a reversal, a big move in price. It's very simple, right? ES sweeps a low, and NQ doesn't. If NQ sweeps a low and ES doesn't, vice versa with highs, right? Let's check this one. Okay, that's more of an equal high, but great example right here. It is. I mean, I don't know what else to explain about it, right? Pretty simple. You should get on that. Next, CISDs, change in state of delivery. Now, obviously, this is just a confluence. Again, just like all these other confluences that, just as a disclaimer, all these, you need an actual setup behind them. You cannot just trade solely off of them. It will be a lower win rate. You do not have any systemized backing behind it. Again, CISD, change in state of delivery. So as an example, we have a downtrend right here, obviously. And where's the highest body of the last manipulation leg? It is right here. So what a change state of delivery is we have a body closure above. Now, this obviously wicked that, so let's see the next candle. Boom. Okay. So the change in state of delivery was when this candle closed above this wick, because we are changing the state of delivery that we're delivering off of for the previous amount of price action of the day. What does that usually trigger? A long entry, as well as an inverse or whatever the setup was towards the high, right? So let's see it play out. Boom. Okay. So that was just an example of a CISD. We changed the state of delivery of where price is going. Some people call it market structure shift. Some people call it this, call it that. Simplify. You don't have to care about these huge, weird terms. Be human. Understand that we are changing the state of delivery. Go back to vocabulary class second grade. Change, state, how everything is, delivery. Delivering, how is everything delivering? Change the state of how everything's delivering. If you just look at the chart, you can see it. We are in an obvious downtrend. We sweep liquidity. We change the state of delivery. And we confirm it. These are just confirmations, right? We confirm it by closing the body above that manipulation legs body. Okay, pretty simple. So those are just the reads on the few confluences and confirmations I use within my trading. So now let's get into this. I'm going to take you through exactly my entry model for inverse fair value gaps. This is an example of what I took and how it played out exactly like this, and I caught 78 points with 0 points of drawdown. Let's get into it. So for example, this is New York Open on Monday, June 22nd. So what am I looking for? First thing I need my 3 C's, right? I need my context, confluence, and confirmation. On the higher time frame, I had a bullish bias, right? A bullish trend on the 4-hour time frame and a higher high, higher low formation being created. I have my OTE points lining up, so my bias is obviously bullish. Go to the daily bias video to get the explanation on how to get a daily bias. So I had a bullish daily bias, and with my IFVG entry model, again, strategy 3 C's, context, confluence, confirmation, my entry model, one out of a few that I have. IFVGs, I love them a lot. But there's a little bit more preciseness with them to actually execute them the best way possible. Now, let's get into it. First thing we need delivery and a draw on liquidity. That is the 2 things you need every single time you take one of these setups. So with our bias, obviously being to the upside, we need our draw on liquidity to the upside. Right here, it would be this 930 wick that I act like a data wick with. Then we had a 15-minute gap right above it at this point to get filled, unfilled 15-minute gap. So I have New York high, 930 wick, and then unfilled 15-minute gap above. So looking at our draw on liquidities, we are set. So that's checked off the board. Now our delivery, where are we delivering from? So I would need price to come down and fill this 30-minute unfilled gap right here. Okay. So 30 minutes unfilled gap, bullish gap. So we're going to deliver off of that. target our target to the upside. So next thing after that, we need to come down and sweep it. Okay, before I do anything else, we need to come down and sweep it. That is called sweeping sell side liquidity. So let's watch it play out. Boom. So we filled this gap, right? Or sorry, we filled the 30-minute gap. We are delivering from this 30-minute gap to the upside. And my plan now is to take an inversion to the upside to target our draws on liquidity. Now, what do I need for that? An inversion. And an inversion on the highest time frame possible within this setup off of the delivery of this 30-minute gap. So in this case, it is a 1-minute inversion right here. And it is a 1-minute bearish gap that we need the next thing to close above. Now on that closure above, we are going to look for longs. Now in this case, we need a big displacement candle to take these highs and change state of delivery. So that is another confirmation that we will need in order to enter this. So key things about this inversion right here. You need to have it on the highest time frame possible, because let's look at the 2-minute, right? When we inverse on this play, look what happens, right? We don't have a gap there. Now let's go back to the 1-minute. Look at this. When this candle closes, we have a gap there. So that's very, very important to know. Now, all I need next, we got our sell side liquidity swept for a bullish trade. We have our delivery from that 30-minute gap, and we have our targets right here, 15-minute unfilled, as well as 930 wick, which is New York high, okay? Next thing I need is one candle to close above this 1-minute gap. Let's watch that. Boom. So 1-minute candle close above that gap. I would get my entry on the closure above there unless it is too high on this side. And then I will target the fill of this unfilled 15-minute gap. Stop will be below this wick if needed, but I would put it below the inversion, because if we go below the inversion, most likely going to be invalidated. So my stop would be at an invalidation point. You can put it under this low, you can put it under this low, you can put it under this low, whatever your risk reward is. But in this case, with this big of a displacement candle, I don't have enough risk reward, right? I don't have enough space to have, a smaller stop loss. So with our target that tight, that is very, very important. So what I would do, I would enter on the closure right here and watch it play out. Boom, full TP hit, and watch what happens after. We reverse right at my TP point. Because of what? Because of that 15-minute unfilled gap. So it's very, very important to have all of your things lined up. Everything within your trim points, your take profits, your stop loss, your entry points, all of these things. But this is just a simple setup. The IFVG setup is so simple. You sweep buy side or sell side liquidity, right? Whether that's London low, Asia high, London high, a 15-minute gap, a 30-minute gap, whatever it is. You create an inversion on the highest time frame possible. You watch for the closure above or the retracement back into it, and then you target draws on liquidity. Very, very simple. Okay. That is all I have for the inversion. I'm going to go into rejection blocks next with, it's going to be this exact example actually happening on the same day here. So I'll see. Okay, in this video, I'm going to explain what exactly rejection blocks are and why I take them to Confluence my setups, as well as take the top and bottom ticks as you guys like. So this is going to be, a little bit quicker video. It's not that difficult, but you guys can watch it 10, 20, 30 times, whatever it is. So this is the same day that I use for the IFVG entry. Obviously that's right here. But the thing you want to start out with rejection blocks is you don't have to top tick and bottom tick every single time. There's always going to be other examples of times to re-enter the trade. For example, a inverse value gap on a lower time frame after we react to the rejection block, right? So don't get discouraged if you don't get the best entries possible. So let's get into it, okay? So with rejection blocks, we need to understand that you need a couple things. You need stacked confluences, you need sweep of liquidity, and then you need a reversal, okay? So let me take you through that. So the sweep of liquidity we were looking for here was this 30-minute gap. 30-minute bullish gap that we're delivering from, okay? Two things you need as always, delivery and a draw on liquidity, okay? So our delivery was from this 30-minute gap right here. And then our draw on liquidity was a previous rejection block on the 30-minute time frame, sorry. a previous rejection block right here, as well as all-time highs. So we see it on the lower time frame. We have our drawn liquidity. We have our delivery from this 30-minute gap. And then what are we looking for? Price to sweep out that liquidity and leave these wicks right here. So looking at these wicks, what do they create? They create a rejection block. But most importantly, they create a sweep in reversal. So what does that mean? Why, right? Why are these rejection blocks good? Because they leave orders there. Because we sweep and reclaim so quick, there's still orders there for stops, right? Everyone's putting their stop in there because it's a high probability area. That's why rejection blocks are good. So what is the plan of action, right? We already made our move, blah, blah. Oh, I'm going to miss the move. Oh, I'm going to miss the move. Watch this. What we do, right? Wait for it to retap this rejection block. And how do I mark out my rejection blocks? Again, we swept liquidity, right? This 30-minute gap, left these wicks in a big reversal. So I would put my limit order at the start of this rejection block right here at 773.50. Oops. Towards the upside. And where do I put my stop? I put my stop below the 1-minute wick. Okay, because if it goes below the 1-minute wick, it is invalidated. And then where do I put my TP? At the drawn liquidity. Right? Simple as that. Now let's watch it. Again, we have our things, right? Drawn liquidity, which is all-time highs, and this previous rejection block. We have our confluence, which is this 30-minute gap that we swept. That's the liquidity sweep. Always need a liquidity sweep within this rejection block. That is how I trade it because that's the highest probability way to trade them. So if for example, if there's a liquidity sweep and it's not inside or delivering from a point of liquidity, then it's not valid in my opinion, right? Fair value gap, London high sweep, Asia high sweep, any PD array needs to be delivered from, okay? So I put my limit order to enter at the start of the rejection blocks at the manipulation leg's last point of the body or the lowest body in this leg. And then more importantly, you got to understand that we can hit the midpoint too. The midpoint of the rejection block is very, very high probability. So if you don't want to put your limit order at the start, you can put it at the midpoint and then have your stop loss right below the wick. So that's literally what? 120 RR, right? So you can do it both ways. I like to do it just to be safe on high probability setups, on A+ setups at the midpoint. You can also put it at the start of the rejection block, but most of the times we manipulate inside of it. So again, sometimes you'll miss a setup that goes to the doesn't hit the midpoint quietly, but at least you're safer, right? If that's the route you want to go. But in this case, hit the midpoint of this rejection block. Again, it's a rejection block because we swept liquidity, reclaimed, left these wicks with orders inside of a 30-minute gap. We have our delivery from that 30-minute gap, now drawn liquidity, which is this previous rejection block in the 30-minute, as well as all-time highs. Now let's see how it plays out. If I got my entry here, let's watch it. Boom. Full TP hit right here for a 1 to 10 risk reward. Now, if you put your if you put your limit by order at that midpoint, it would have been a 1 to 20 risk reward, 185 points with a 9-point stop loss to the tick. Simple as that. Now, let's go through it again. We have our drawn liquidity, which is this previous rejection block in the 30-minute, right here. We have all-time highs right there, also another draw. We have our 30-minute fair value gap that we're delivering from, that we filled to go to the upside. We have our confirmation, which is the reaction to the rejection block. And if you don't want to get that bottom tick entry, look at this. 1 minute IFVG right here. Or you can do a 30-second IFVG. Whatever it is, right? We actually didn't even, 30-second IFVG here. Now, I don't use 30-second all the time because it's a little bit lower probability, but this is just saying, like, if you miss a setup, you would have entered here, actually. But If you miss a perfect bottom tick or top tick, you can still get an entry. It's fine. Risk reward might be lower. That's your fault for missing, right? But there's other ways you can do this. You can enter off of the midpoint only. You can enter off the top of the rejection block only. But there's a couple things that are certain, and those things that are certain are that we need to be in a confluence, right? During our inside of our rejection block, we need to be delivering from something, and we need to have a target. Okay. Pretty simple. Watch this over and over again. If you have any questions, obviously ask me. I'm your mentor. But other than that, that is it for me. Enjoy. Alrighty, going again for the famous OTE strategy that I have. Okay, so with the OTE, obviously there's some guidelines with it. I mark out my Fibonacci tool in the 3-minute time frame every single time for these key open OTEs. I anchor the impulse leg that broke structure, and if it's bullish, I do the lowest wick up to the highest body. Bearish, vice versa. My entry is going to be in the golden pocket, 6.2 to 7.9. The sweet spot is 7.05. You really want to go to the sweet spot at 7.05 for an entry, but confluences must sit inside the zone. You need to stack confluences. Beyond the 786 is where I put my stop loss, or beyond the invalidation point. The target is the draw on liquidity, the swing high or low the range points to, and it's best paired with a sweep and reclaim off of a 4-hour open or kill zone, confirmed by a chain and stated delivery if you need. So let's go to the charts. Okay. So this was actually one that I took, 20 minutes ago? So it actually happened tonight. And I'm going to give you guys kind of a run through how it happened. So obviously you need to come in to the day with the same attitude with context, confluence, confirmation. You always need those. So my context is my daily bias and my nightly bias, which is obviously bullish after the day we had, as well as the higher time frame structure. So coming with a daily bias of bullish, I am looking for a bullish OTE trade. So what do I wait to do? Right here, it is still the previous day. So we're going to wait until 6 p.m. opens. Okay. So obviously 6 p.m. opens right here at 1800 on the military time. So that is where my key time is. So I'm going to see like, okay, if we make a move lower, I'm going to keep going down to see where I'm going to anchor my Fibonacci tool on the bottom for a bullish trade. So let me take you through how to anchor it when this setup presents itself. So as it's creating, right, a range here, I see where the prominent low is, right? So the prominent low obviously is, let's go back here. The prominent low is, hello. Oh, never mind. Not sure why that's happening, but so the prominent low is obviously the manipulation leg before the key time open. So the lowest point we got during that 6 p.m. key open was this point right here, which is actually before. So that was the manipulation leg, right? So we mark out the manipulation leg, and then obviously we're targeting for it to come back into this golden pocket, the 705 level. Now, what do we need for that? We need it to line up with confluences. It lined up with, let it load, a 30-minute rejection block, okay? So 30-minute rejection block right here lines up with the 705. And on the 3-minute, we come down to it and tap it right there exactly. So not to get ahead of myself, but this is how you anchor it. So manipulation leg for a bullish trade, the lowest wick we have to where we don't want to go on a bullish trade, to the highest body of where we do want to go. We want to go up. This is a bullish trade, right? So all I do, I wait for it to come down to that 705 mark, as well as the rejection block area, which lines up with my 705. I take it off of that and target the high of the range. So high of range is our drawn liquidity. We are delivering from obvious previous gaps here, as well as a rejection block, most importantly. Our stop loss will be going below the 1-minute wick that we created for a rejection block paired with this. And then our TP will be the range high. So that is a 1 to 18 risk reward. This is a Asia trade, so it was slow, a little bit lower volatility. So it was only a 37-point trade. I have OTE trades where it's a 1 to, like 10-point to 250-point gainer. But this is just an easy example that I took literally like an hour ago, 30 minutes ago, whatever it was. So That's why I'm giving you this example. Now, some common mistakes that you can make. Anchoring it in the wrong spot. For a bullish trade, you always want to be in the lowest manipulation wick, right? To the highest body. Some people do it to the highest wick. That still would have worked out here. No issue, right? I like to do it in the highest body 3 minute because that is where I see the most success. And I see that we target the higher the range every single time at least, right? That is the safest bet. Unless you're targeting another draw on liquidity right here, which was my next one, which is this 3 minute gap fill that we also tapped, but we didn't get above those wicks. So I was like, okay, if we tap into this gap and we're not above those wicks, at least I can be safe taking it at the range high. So those kind of things are discretionary that I just think about in my head. So that's how you have to use this entry model too. You got to have some discretion with it. But most of all, right, delivery, draw liquidity, entry point. Now, going into where, some points you miss the entry, right? Wait for a retrace or wait for a inverse fair value gap, whatever it is, right? Let's see where the next inversion was here. Didn't really have one until here, and then closed above it there. You would have got a bad entry, but again, next thing you can look for a change in state of delivery. So if we change the state of delivery, we would have to close above this candle right here. So again, would have got a entry in the same kind of area. So again, you always want to have these good entries at the 705. Again, for bigger risk to reward, you can get a different entry, but in this case, it's only 37 points. So you want to get a good entry. You mark it out in the lowest wick of where we don't want to go for a bullish trade, in the highest body on the 3 minute, obviously. But where we do want to go, target the range, entry on the 705. You have to stack it up with different confluences, okay? Another example of a confluence could be, obviously an order block, rejection block, a fair value gap, an inverse fair value gap. All these things, I usually pair it up with a fair value gap on like a 5 minute time frame, because that just gives me the most success with it. But it is a pretty simple strategy. You just have to anchor it right. I think that's the most important thing. Now, going into a couple different mistakes that people make. People sometimes, anchor it too early to where okay, this high was created, then we only can go off of that high, for example, right? But you got to let the range create itself. If the range doesn't have a bigger retracement and a prominent high, then we don't set the anchor cemently, for lack of a better term, right? So it has to create a prominent high and a retracement. So that's what I call a retracement right here, right? Prominent high, swept this body, comes down. Oops, I was still running. So that's where I would anchor my high at this point right here, because we created that prominent high. That's a big mistake I see people make. So to put it in replay mode, okay, let's take you through this whole thing. So 6 p.m. OT, 6 p.m. Asia opens up right here. I anchored the wick here for now, unless we make a lower low, which we haven't. And then obviously as the candles get higher, I keep moving them up until we create a prominent high. If we create that prominent high here, we haven't created that prominent high yet. So I'm going to keep moving it up, right? Not moving this bottom wick, only the top wick. Did we create another high? Nope. No, we didn't, right? So what do we do after that? We wait for it to come down to our 705, mark it out with our rejection block in the other time frame, and then I get an entry either at a limit order at the 705, or you can wait for confirmation, enter off CISD, or an inverse value gap. We enter there, target the high of the range, and then watch it play out. Boom. Simple as that. These type of trades will give you the most bottom and top ticks, in my opinion. Not that that's very, very important, but it's pretty beautiful when these play out. Now there is a lower win rate with these type of setups. Obviously, with the insane risk reward that we have, obviously it's going to be a lower win rate. Don't try to re-enter so many times. If it doesn't respect that 705, then it's not going to be valid. If we don't have confluences here, it's not going to be valid. We need to stack at least 2 to 3 confluences on the lower time frame. I'd say 1 5+ minute confluence on the middle time frames, which I say 5 to 15. But you really want to stack as many confluences as possible. Going with SMTs as well, right? Have an SMT right here. That is just another confluence that we could stack. So SMT, rejection block, fair value gap, inverse value gap, all lined up with the same spot, the 705. Now let me tell you why we like to come to the 705. So this area here, from the 0 to the 0.5, that is called premium. The contract is in premium price. So you don't want to enter in the premium. You want to enter when it's in discount from 1 to 0.5. So when it's in discount, that is a high probability that we're just rebalancing volume to go higher, right? That is the whole point of discount and premium. So we always want to take a trades in premium. So that's stacked, or sorry, discount, and that's stacked, right? That's one stack. We have a rejection block around lining up with the 705. That's another confluence stack. We have an SMT with a yes at the lows to go bullish. That is another confluence stack. And our bias is bullish, right? Trust your setups. This works. Your psychology is going to make it not work. Don't be hesitant with these entries. Don't. Okay? Trust them. Have a tight stop loss at an invalidation point or under the wick like I do, or an invalidation point like 786 or 0.88, right? Usually we don't cross the 0.88 if we're going to actually play this trade out. I do see sometimes that we cross the 786, but that depends on where your confluences are, right? Now, if it's like a 5-point difference from 705 to 0.88, you can put it below the 1, right? Because sometimes we can manipulate. But more times than not, we do not come past the 0.88 when we have a valid setup. It's pretty self-explanatory once you put it in front of your face. Now, you're going to have to probably rewatch this a couple times. Key points I can make. Always wait for it to come back to the 705. Don't enter on something like this. It edged it. We didn't create a prominent high. We want the actual move, right? Let it create a prominent high. Be patient. It's always going to come down to the 705. It always is. I'm going to touch a little bit on standard deviation as well. Okay. With standard deviation, we mark out the manipulation leg before our big move. And that tells us where we are going to project price. Okay. Let's, for example, here, stopped right there around that area. But when we look at our play here, okay. Oops, I'm messing this up. We tend to stop at our standard deviation projections. Now, that exactly lines up with this zone right here. So if you don't know where to take profit, using a standard deviation model will help you project where it goes. Now, overnight, it's probably going to hit that, blah, 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 whatever happens. I like to take profit at the range high that we created. You can use standard deviation for these type of trades where you mark it out from wick to body, and then you wait for it to hit one of the projections, or you could do body to body, or you could do wick to body on the downside in this case, right? Everyone does it differently. I usually do body to body on the manipulation leg, right? So where's the manipulation leg? The last move down before we made our move up in this case, right? And vice versa for a bearish trade. So mark out the Fibonacci tool with your manipulation leg, and it'll show you the projections. I usually like to take profit at the 2.25, but this whole zone is basically acting as a golden pocket, as well as the last projection, the -4, as the last kind of resort for the expansion. Now, this probably went back up here after it pulled back for a little bit to end up finishing that projection leg. But my point is, when saying that, is we could have us hit the 2.5 or the 2.25 in this golden pocket here, make a huge move down, not taking this low out, but make a big move down, and then go higher. So you really want to lock in those profits. And that's why for these type of trades, I'd like to use the 2.5, 2.25, and the -2, -2.25, -2.5, sorry, for my take profits with this type of setup. Because one, it lines up with the range, the end of the range. Two, if we hit those and I get break even, I will be very pissed. And then obviously go to full TP. So there's a lot of different ways you can do this. I have a lot of, more videos on this, but I hope you understand that this is a lot of discretion, right? I'm giving you the framework, but you got to use the discretion. Thank you guys very much, and I hope you understand. This is a great strategy and a great entry model, and I am so blessed I learned it. So rewatch this 10 times. Alrighty, welcome to maybe one of the most important videos of this course, the DGF strategy, the famous DGF strategy that I'm coding my automated trading bot on. Will be out soon, I will let you know. But this is the DGF, this is the Duke's gap fill, my gap fill strategy that I created a couple years ago because I saw so many times that this was happening. I just could not create an entry model off of it. So basically what it is correlating with QQQ and NQ, and we look for the gap fill on QQQ because it happens so many times, and optimizing that with a good entry. So the setup is QQQ leaves an unfilled gap overnight, NQ is drawn to fill it. The gap zone is often $2 to $6, not points. But obviously you can get up to 20, whatever it is on QQQ that we've had, especially with higher volatility. I'd say I wouldn't have a valid setup if it's under $2. So I wouldn't take it if the gap is under $2 because that would be too quick and we wouldn't be able to sweep our session highs and lows. So the entry is let the sweep take the session liquidity first, London high, then enter the IFVG on the reclaim. When it fills that, taps on the gap, and then comes back down, we enter on the IFVG entry. So our stop loss would be above the highs, the displacement candle, or the CISD. The QQQ gap fill would be our target, and then the opposite liquidity. Obviously, if there's high volatility, then we would do just New York low or some sort of liquidity to the downside for sell side. It's best paired with a clean sweep of the prior session higher low plus a lower time frame IFVG or CISD. Let's get into the chart. Let's do it. So on this day right here, we had a bearish bias because let's go through the checklist, right? What do we need to look? We need to mark out our session highs. The London high was right here. We had a 1 hour bearish gap right here that I marked out on the 1 hour time frame. Then looking at QQQ, what did we have? We had a big gap, a large gap, right? $6.61 as a gap right at the top of the sweet spot, okay? So what do we look for? Next thing we look for is to open up, come sweep London high, as well as tap into that 1 hour bearish gap, look for the reclaim to the downside, find the inverse value gap, enter, and then target New York low, as well as targeting the full gap fill on QQQ, and wait till the end because you'll see the correlation with this, okay? So let's go into it in real time. So obviously what we're waiting for now, market open, we took out some lows here. We are making a move up, kind of choppy, but all we're waiting for is for us to sweep this London high and tap into that 1 hour bearish value gap for the delivery. Again, always need this, delivery and then draw on liquidity. Delivery is delivering from that 1 hour bearish gap and London high sweep, and then we are targeting the full gap fill for our draw on liquidity and New York low as our draw on liquidity for a trim for this type of setup. Now, disclaimer, this type of setup is high RR. It might take some time. You do not use high size on it. Stops may be wider, but the RR is pretty dang good. On this trade, I put my stop above this 1 hour bearish fair value gap because that is my invalidation point. And it was around a 1 to 10 to 1 to 13 risk reward. And it happened over the course of the morning. So let's watch it play out and let me explain to you exactly how it works. So right now I'm waiting for it to sweep London high. So as we do right here, we start chopping and then we go towards London high. We sweep London high and look what we do. We tap in that 1 hour bearish value gap. So the mode I'm in right now is, okay, look for the nearest entry point, okay? Stop goes above that 1 hour bearish gap. And then we look for gaps. We look for our highest time frame gap. Do we have a 2 minute? No. Do we have a 3 minute? No. Do we have 5 minute? Obviously not, right? So on the 1 minute, we found our only gap, okay? Going back to our IFVG strategy, go back and watch that video. I would need to enter on the closure below this 1 minute bullish inversion, bearish inversion, right? Bullish gap, we need a body to close below to create a solid inversion. These bodies did not close below, so I'm still waiting. So right now I'm waiting for that entry point. So let's watch it. Okay, so first thing we got, let's go back a little bit. First thing we got our closure below this bearish gap right here, or sorry, this bullish gap right here, which creates the inversion. So what do? I can either enter on the closure or I can wait for it to retrace this 1 minute IFVG. So for example, if I wanted to wait for the retracement, set my limit order at the fill of the 1 minute gap, stop loss above these highs, full take profit at the full fill of the QQQ gap correlating with NQ. I'll show you guys how to do that soon too. But if we also, so that is 29K for a reward, and we are risking 6K. So what is that? A 1 to 5. Okay. Also, you can also put your stop above this wick, which what I probably would have done if I got this type of entry, right? So that would have been a 1 to 7. So let's see it play out in real time. You go to the 5 minute to watch it play out too, so it doesn't take up my whole screen. All right. Actually, let's go to the 1 minute to watch the retracement. So let's watch it tap us in. Boom, retrace the gap right there, tap this in, immediately delivered. Now, what am I going to do? I'm going to make sure I have a trim point, right, at this New York low right here, okay? So since we're in a buy sell position, I'm going to put a buy limit right there. So I'm trimming contracts, and then I put my stop loss to break even once we hit that. So let's watch it. Boom, first TP hit, stop loss to break even. Now it's a risk-free trade. I already made 198 points at my first TP, which is crazy. And then let's watch it ride all the way down to this full gap fill on QQ. Now watch, hold on. We are halfway to filling this gap on QQQ and halfway to my TP on NQ, right? Nobody leverages the NQ gap fill. And look exactly where it reacts at the full gap fill. Look at QQQ. Boom. Fully filled this gap. Where exactly does it tick out? Boom. Fully at my full TP. And then look at this. Reacts back to the upside after that because we hit our draw on liquidity. This is such a good setup when you can really understand it. The correlation between QQQ and NQ is they're the same thing. They're both the NASDAQ, but QQ is the obviously the if you want to trade options on it, if you want to buy shares of it too, and NASDAQ is the futures ticker. But they do correlate, right? So this type of setup happens so much. Let me take you on the higher time frame on QQQ to show you kind of how much this happens. Like it's crazy. Let me go to like a 5 minute time frame. Okay. Gap filled. Sweep below, gap filled. Sweep a high, gap filled. Doesn't matter how big it is. Look at this. $21 gap on Qs. Filled. Obviously, we're going to have gap up days, and sometimes it's not going to happen. It's okay, but it eventually does, right? Open, we have a gap here. Sweep a high, gap filled. And then obviously we have these crazy gap ups from Trump. Thank you, Trump. Open, have a gap, sweep a high, fill the gap. Open with a gap, sweep a low, fill the gap. It's clockwork, guys. It's genuinely clockwork. Open, sweep a high, fill the gap. Open, sweep a low, fill the gap. Open, sweep a high, fill the gap. Open, sweep a high, fill the gap. Open, sweep a high, fill the gap. Open, sweep a low, fill the gap. Open, sweep a low, fill the gap. It's clockwork. It's genuinely clockwork, guys. And once you understand this, You're going to see so much clarity within why these moves happen. And that's really the point. So if you did enjoy this, watch it over and over again because it's going to give you a lot of clarity on why we make these moves. Like I said, but this is why I'm getting this trade audit or this system automated, right? This strategy automated, so it can catch these type of trades without even me looking at it. So stay tuned for that. And yeah, pretty simple, pretty self-explanatory. One of the best trading strategies I've ever traded. Watch this video many, many times and enjoy. Thanks, guys. This is the part where you guys don't want to understand, right? Psychology. Now, psychology in trading is 80 to 90% arguably of trading, and why I'm profitable and why these other guys are profitable is because they locked in the psychology. Now, there's a lot of things you can look at when talking about trading psychology, but I put some key ones down and I want to exactly tell you how I got through these roadblocks and these chokeholds within my trading psychology and got to that next level to be able to not be affected by it. Okay. You don't lose to the chart, you lose to your own head. Okay. The technicals are solvables. Your reaction to a red number is the real test where the game is actually won, right? 90% psychology, like I said, 10% technical analysis. So the spiral that ends accounts, right? When you're near your max loss, you size up to make it back. You blow the account, you rage, you revenge trade. Have you went through that before? Because I have. And I definitely did when I was unprofitable. And that's the biggest cycle I see within you guys. And it repeats, right? The market doesn't end accounts. This loop does. Scared money, holds losers, cuts winners, sizes up to get it back, marries the bias, trades every candle, chases green days. If you think this way and you resonate with those scared money, attributes, then listen up for the rest of this video. Okay. But process mind, cuts losers, runs winners, sizes by the plan, trusts bias, tips the cap, takes the no trade day, chases I followed my plan. That is the way to do it, right? But it's not that easy. Let me show you how. Okay. You got to rewire it, right? Tuition, it's not a verdict. Your first blown account trains the mind detached from it. The law of detachment is very, very big, and I'm posting another video on that too. No trade is a win. The reward is position, not how many trades you take. Journal the feeling. The number doesn't lie. Your emotions do. Log both. Block the noise. Their payouts are not your plan. Run yours. Okay. Now, going to my kind of experience with this. I've lost more accounts to my own head than to bad setups. Every trader has, right? You start to notice once you're at that like break-even phase where most of you guys are, you realize that if you just took the setups that you told yourself you were going to take and the setups that works, right? The strategies that I give you that works and it's proven, then you would be profitable. You'd be getting payouts left and right. But what's that thing blocking you? Your mind, your emotions, your attachment, right? So you have to detach. You have to detach. And really psychology, what it is at the end of the day, it has a lot of discipline in it. And at the end of the day, it's if you want to have a conversation with yourself and you want to stop going through these cycles like I was just talking about, but that comes from within. I didn't make that switch for me, locking my psychology and actually becoming profitable, breaking out of that, ceiling that you're at a break even, until I just sat down with myself and said, okay, my back's against the wall. I have to make this work. And if you're in that position, you have to make this work. You have no other choice than lock in your psychology, right? So even if your back's not against the wall, you have to stop making these mistakes. You have to stop thinking you have some room between your back and the wall, because that's just prolonging the process. So more into my story, when my back was against the wall and I had nothing else and I needed to make this work, it's crazy how it just started working then, right? That's because I got tired of making the same mistakes. I got tired of going through that cycle. I got tired of all these things, and that's what pushed me. So I'm here to tell you guys, you don't have to get to that point. You don't. And what I'm here to do is show you that I don't want you to make the same mistakes that I did. That's my job here as your mentor, right? So the chart is the easy part, right? It's solvable. You can play with the discretion and technicals, but your reaction to a red number is the real test to your psychology. Wonder why Top Step and all these firms have red all over your screen when you have a losing day. Your P&L's, red, and you lost your trade because they want you to see that and be like, oh my god, that's bad. Red means bad. Green means good. And that's like, okay, I can't end on a red day. I can't have my screen red. I can't have my P&L red and close my laptop on the day. No. Yes, it's okay. It's okay. Right? Because how many times have you said that to yourself? Like, I'm like $100 in drawdown. Let me just get $100 real quick. I'll just size up and stuff. All of a sudden, your account's gone. $2,000 down the drain. And all you wanted is that $100, right? That's how easy it can go. And being able to lock in the psychological part of, okay, I've done this before. I've blown my account from making that $100 move, right? I need that $100. I've blown my account. So am I going to make it again? Am I going to do that again? Because maybe this time will be different. That's a big one. Maybe this time will be different. It's not. Yes, you might get lucky sometimes, but 9 out of 10 times, the long road, it's always going to come bite you in the ass. And I've said that so many times. Journal, right? So this is the part of this where I'm going to tell you the actionable steps to do, right? The SOP, the standard operation procedure, right? Journal every single emotion. Okay, Code Dukes on Trades LO. Sorry. Journal every single emotion. Journal every single reason why you took a trade, because if you journal every single reason why, and you can't journal a rush trade or revenge trade, an over trading session, you can't journal that because you don't have a reason why. So that totally blocks it out, right? Go through a checklist every day. Why am I taking this trade? What are my emotions? Are my emotions in check? Because everything comes down to discipline at the end of the day. If you want to lock in your psychology, it comes down to discipline, right? Are you disciplined enough to not be greedy and want more? Are you disciplined enough to cut your losers at the stop loss you set, right? Discipline. The exact definition is doing things as you said you were going to do them, right? You said you were going to get out of that trade at that stop loss point. You did. -10 discipline. You said you were going to take profit at that point, but it keeps pumping. You want more and more and more. All of a sudden it reverses, right? These little things will screw you up. So understanding that psychology is 90% of what this whole thing is, man. It's 90% of it. And if you don't understand that, you won't understand that that's what it takes to be profitable. And I know it's hard. And let's get into the deep parts, okay? The deep parts. I was in that position too, where I couldn't stop making mistakes. No matter how many times I sat down and said, okay, this is the last day. This is the last day. I'm stopping these overtrading. I'm stopping revenge trading. I'm stopping getting in these mental battles with myself that I can't seem to get out of and detach from. I promise you, no matter how many times you say you're going to stop, you probably won't, right? Until the day where you take actionable steps, okay? You're going to blow your first couple accounts, but that's tuition, right? It's not a verdict with it. You got to detach. The people who never blow one are usually copying someone else's trades and learning nothing. So don't get discouraged about that, right? Comparing yourself is a huge thing with this too. You have to block out all the noise, right? Looking at other people's P&Ls, looking at other people's success. 9 out of 10 times it's fake. So don't compare yourself. Everyone has their own journey. So do not compare yourself. That's a huge part about it, right? More into technicals, right? Don't marry your bias, trust it. But when a clean setup stops you out, tip your cap to it. Don't overtrade. Don't try to get in more. Don't try to average in. Tip your cap. You got manipulated. You lost the trade. That is it. You don't spiral out of that, okay? So name the drawdown spiral so you can kill it, right? You are a few hundred from your max loss. You size up to make it back. You blow it. You're furious, you revenge trade, that sequence ends accounts, not the market, right? You get into this spiral of, okay, maybe if I get lucky on this one, okay, I didn't get lucky on that one, but I might get it next time, right? That will never work. You got to detach from the money because trading is scared and makes you hold losers and cut winners. Confidence comes from your process and your buffer, never from the one trade that you want to get lucky on, right? And you got to understand this is a process, right? You have to do things the right way. And if you want to leave this video with one thing in your mind, it's this, okay? If I could tell myself one thing, when I first started trading, to take away so many losses, to take away so many months and years of unprofitability and just pain and anger, is this isn't something that you can skip the process. You can't skip a cutscene. You have to do the little things, and you have to do them right. You have to journal. You have to get in touch with your psychology. You have to do things the right way. You have to follow your rules. You have to have a checklist. You have to have every single little necessary thing that all these traders talk about. You have to do those, because you can go one way or you can go the other. One way, okay, I don't need all that stuff. Man, I can get these payouts without doing all the little necessary things. And then maybe you get lucky for a couple months. Maybe you get a couple payouts. But then it always comes bites you in the ass, because you didn't lock in that discipline. You didn't lock in your psychology. So it'll never long-term LTV, long-term value, right? It won't give you long-term value. Or you can go one way, the first way, the right way, which is, okay, my mentor, he's telling me that he made these mistakes and he would want me to never make those mistakes, even though I think that might be wrong, right? I'm going to do the necessary things, the little things, the journaling, not over trading, tracking your data, all these little things. I'm going to do those, even though I don't have a problem yet. I'm going to do those so I don't have to run into this issue of it biting me in the ass later. There's two ways you can go about it. But at the end of the day, leave with that and leave with this. It's you versus you. Do you really want this? Because if you are still making these same mistakes over and over again, you don't really want it, do you? Because you don't. Because I promise you it's that deep. I swear it's that deep. So have a conversation with yourself. Think about if you really, really want this or not, and you'll stop making those mistakes over and over. All right, risk management. This is one of the biggest things, as well as psychology, okay? Treating your trading like a business pertains to having risk management, right? If you invest into something for your business, you need to know the exact risk you take when you invest into that, right? If you're treating trading like a business, you need to know the exact risk you're taking every single trade and have consistency over time. Everything I talk about in this video and all of my videos is for a long-term goal. It is not a get-rich-quick scheme. It is not something that you will use once and not be consistent with it and then expect to be profitable. If that is your mindset, then get off of this video right now. So obviously this is my framework, right? The math that carries you. You do not need to be right often. You need to be right big. So what does that? You can have a 30% win rate and still be profitable. You can have a 20% win rate and still be profitable. But your risk management needs to be locked in, right? With a lower win rate, you need to have a higher risk to reward. Meaning you need your stop loss, for example, $100, and your TP, $1,000, a 1 to 10 risk to reward. That needs to be consistent over time because of your win rate. Now, one thing I can tell you, and that helps me a lot, you need to understand that you need to have consistency with your max loss every single trade. Doesn't matter how big your stop loss is, just size down if it's bigger, just size up if it's littler. But that max stop loss dollar amount needs to be consistent. And that is what changed my trading risk management wise, right? So size to the stop. Your risk out is fixed. The chart sets the stop. Your size is what flexes. The size, risk, dollar amount divided by stop distance. Obviously a wide stop, lighter size. So meaning if you have a trade that has an invalidation point that is, a little bit bigger than normal, let's say it's 50 points instead of 30 points, and your average stop loss is 30 points. Well, all you need to do, you don't change the dollar amount of your stop. You just need to lower your size, right? Vice versa as well for TPs, right? Type stop, heavier size. This is how you can be consistent with your risk management. So this is how you manage the trade. You trim at target 1, bank a piece, take the pressure off, stop to break even, let the runner run. So this is a system that I've been using, right? We have our validation point for our break even, right? And most people, don't take profit or don't trim at all, and they put their stop loss to break even. What I do, I take a partial at that break even point, as well as put my stop loss to break even. Not only am I in a risk-free trade, I also took a piece of the pie, however much it is. Now, if you don't put your stop loss to break even at that trim point, you have to obviously take half or more out of the position, so your position doesn't get messed up risk management wise. So trim, stop to break even, let the runner run. your runners will do so much better for you than you think. So let them run, right? But the guardrails are, say your max daily loss before the open, hit it, and you are done for the day. You need your max loss, like I said. And that is the daily loss as well for each trade, okay? So, second, stack Confluences, not size. Conviction is not contract count. So even if you think, right, this trade is, oh my God, it's A plus 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 plus, but you want to risk like double your normal risk, that won't work with data collection over time. It won't. You have to be consistent. Now, 1 or 2 more micros in this trade and put your stop a little bit tighter, that's okay. But you need to know the difference between them, okay? Just because you see so many good Confluences in such a perfect trade doesn't mean you full port. That means you adjust your risk towards that, right? Bigger risk to reward or tighter stop loss if you're going to use more size. Just like the phrase where I was using, bigger stop loss, you use less size. Okay? It has to all be consistent. 1 clean risk unit per trade, know the loss before the win, right? You need to know that you need consistency within your contract using 2. Now, you can size up over time, you can size down over time, but the same rule applies, right? Size up, tighter stop. Size down, bigger stop, whatever the invalidation point is. Now, what I use for my stop losses are invalidation points. Sometimes they're 30 points, sometimes they're 50 points, but most of the time, or every single time, I always have the same max loss. Now, growing up as a trader and scaling, as I'm going to get into that, that means you are going to size up, especially if it's on a live account. But on prop firm accounts, you should be using the same size because it is the same, obviously, account, unless you go to 150K and go down that route, live accounts like me. But you need to know your rules before you get to any single trade. How many contracts am I using? What's my max loss? What's my risk to reward? Where's my trim point? When am I going break even? All of those things you need to know before you take a trade. You need to have it down, checked down. Obviously, you never full port. This is a huge part of risk management. If you full port, you know what's going to happen. It's never going to end up well. You might get lucky sometimes, but again, it's always going to come bite you in the ass. Okay? Do not marry the bias. Stop on a clean setup, tip your cap. This is a big thing in psychology too, right? If you can't journal and have consistency with your risk management, if you overtrade, then why do you do it? It's like making a emotional decision to go gamble the money you are about to invest into your business, right? Yeah, you might get lucky once, like that one dude for FedEx, but it'll never end up good if you keep doing that. So why are you doing it in the first place with trading, right? So for example, like if you get stopped on a good setup and you really like the setup, yes, you can re-enter on a actual validation point, but if you just re-enter out of FOMO, that is going to kill your consistency within your data. Okay, because it's just not right. And you need to do these necessary things right. Okay, a green day means bank it. The account is up, protect it. Now, most of you guys come to the point of greed where you're like, okay, I really, really want more. I see it just pumping and I was in a long and I took profit and I followed my rules, but I just want more and more and more. That is where you will blow your account. And again, it goes back to this. Are you able to journal a FOMO trade? No. Right? If you miss the setup and it goes straight to your TP and you enter after your TP thinking it's going to keep going, you get stopped out, you can blow your account. All of these things happen for a reason. It's to humble you and it messes up your risk management. Okay? All these psychological things mess up your risk management. Every single one of them. So it always comes down to one thing. And that one thing, if you know me, you know what I'm about to say. Discipline. You got to be disciplined in all aspects of trading. Or your data is going to show. It's going to show. The data is going to show when you are not consistent with your discipline within your risk management. But yeah, I mean, some rules, right? Like my stop lives at validation, never at a random dollar amount. It goes where the setup is proven wrong, right? I don't put my stop loss to a certain point or, below this point validation at 29,000, right? I always put it at where it doesn't make sense for the trade to go to. Because at that point, why am I still even in the trade if it's invalidating? For example, if we have a displacement candle that creates an inversion and we confirm the inversion, I'll put my stop loss under that displacement candle, the liquidity sweep as well. Because if we get down below that, that's literally just a lower low. So why would we, it's an invalidation point. if we get down to that point, the trade is not valid. So what are you waiting for to happen, right? So if the trade does not work with a logical stop, you do not take it. Skip it. There's always another. So the math part about it, right? Again, like I said, you don't need to be right often. You just need to be right big, right? Your winners need to be bigger than your losers. That's just simple. For example, a 1-to-1, you have to win half of your trades just to break even. At a 1-to-3, you only need 1 in 4 trades. At 1-to-5, less than 1 in 5 trades. Think about that. Your win rate doesn't need to be that high. It doesn't. Now, I do have around an 81% win rate with an average risk reward of 1-to-3. So it's not even close, right? It's not even close. But it's only not even close because my risk management is locked in. I don't deviate from it. Because if I did deviate from it, I could have I could have a 99% win rate and still be unprofitable. Think about that. How crazy is that? That 1%, I just full point. How crazy is that? So that's how important it is. So the dollar amount at your risk is fixed, right? You decide that number before you take the trade. Your chart sets your stop distance, your position size. The only thing that flexes, so your size equals your risk divided by the stop distance, right? Wider stop, lighter size, tighter stop, heavier size. So the same risk is out every single time. You never let a wide stop turn into a big loss because you forgot to size down. That is just a terrible mistake that you could make that you don't want to make because that is just an emotional decision. So how to manage the trades with your risk, right? You trim at your first target, like me. You bank a piece and then take the pressure off of your head, meaning you put your stop loss to break even. You have a no risk-free trade now, right? So you let the runner run to your draw on liquidity. That is where the outsized winners come from. Now, with risk management, we have some traders who have big RRs, average risk rewards, 1-to-10, 1-to-20, and they really, really rely on runners. And runners are very, very important because that is where you get your full edge within your consistency and your risk management. Because you're actually taking those trades to those full RRs. That's very, very important. So obviously you have your guardrails as well. You set your max daily loss before the open. You hit it, you're done, no debate. You never full port, right? Aggressive size is not a reckless size. You stack confluences, not contracts, right? Conviction is reasons, not size. Don't marry your bias. You stop down on a clean setup, blah, blah, blah. Tip your cap and move on, right? Know the loss before you dream about the win. This is a big psychological part about it too. Focus on how much you're going to lose. Focus on that. Because you won't have the greed if you're thinking about that. You won't have the greed of, okay, how much could I win? No, it's how much will you lose if you get stopped out, and how much will you make if you take profit. It's not could. Take could out of your vocabulary when we're talking about risk management. Okay. If you have a green day, right? Lock it in. Lock it in. Because how many times I tried to overtrade when I have a green day and I just feel so confident and it just messes up my whole account. You don't want to have that feeling. So at the end of the day, trading is not about being right. It's about staying in the game long enough for your edge to pay you. Does that make sense? So you risk first. The setups take care of themselves. Okay. If I want you to leave here in this video with one thing is I understand the emotional part of risk management to where sometimes you want to size up, sometimes you want to size down, sometimes you have, maybe you don't have time to change your contracts. Those things are so important, so do not overlook them. The same way you look at, how many funded accounts am I trading on this trade, that should be nothing compared to your risk management. Okay. It is very, very important to keep risk management clean and consistent, because that is the only way you can execute on the data you are collecting. Okay, so a huge part of your trading journey is journaling. Now, before I get into why journaling is very, very important, let's take you through how to journal. So this is a journal entry spreadsheet that I created for my student, Jake. Okay, so how to use this journal. First thing, the rule, 1 trade in, 1 row logged, do it before the next setup, no skipping the losers. So for example, if you take a loss and you don't want it, you're so embarrassed by it, journal. You have to. That is the most important thing you should be journaling, the losses. Okay. So first of all, you obviously do date you took it, what session, London, Asia, New York, whatever it is. Most of your live reps are in New York, 9:30 to 11 a.m. EST. If you are a New York AM trader like Jake. What direction, you took a longer or short, your entry model, OTE, DGF, continuation, IFVG, whatever it is. Your bias and context, your high time frame read, bullish, bearish, and why, the C1 and 3 Cs. Obviously, your bias going into the trade. The confluence you used in order to take the trade, because you need confluence every time you take a trade. Your entry, stop, and target. The prices, this is how you check your real risk reward after the fact. Your planned risk reward. What do you expect going in? For example, 1 to 3. If your average risk reward is 1 to 3, what was your risk reward going in? Or sorry, what was your planned risk reward? And then what was your risk reward after? Your result in P&L, did you win? Did you lose? Did you break even? The dollar signs. You got to be honest here. I know you try to inflate some things sometimes, but this is where you have to be honest every single time. Did you follow the plan, right? So here it's kind of going into psychology of it too. Like, did you follow your plan? Be honest. Again, be honest. I can't stress that enough. So also emotions after that. Before, write down your emotions. During, write down your emotions. Remember that. After, write down your emotions. This shows you what you are feeling when you're taking this type of setup. That lines up with everything else you put it here. Okay, in this setup, I feel this way, right? In this setup, I feel this way before, and then after I feel this way. Okay, so what's the discrepancy in that? And how can we help you get past that, right? These are the things that journaling helps. What was the mistake or lesson, right? If you won or lost, there still can be a mistake, even if you won. There still can be something that we can learn from if you won. But there also can be a win, right? Something you learned when you lost, always, right? So that's why this point is very, very important. Now, obviously, you grade the trade, grade the setup, right? If it's an A+ setup, you grade it A+ setup, even if you lost, doesn't matter. So obviously, TradeZella is very, very important for this. Let me take you through what I have for my other students with TradeZella. So for one of my students, Alex, right, he goes into the TradeZella, which I have mentor mode on, so I can see everything Alex does within his trading and every single one of his notes that he puts down in his daily journal. So, okay, he sent me the screenshots, he did all these things, and he also has a spreadsheet with all of the things I was just talking about. But TradeZella is a really, really good platform. Let me take you through how we use it. So, for example, this is a demo chart on TradeZella. Obviously not mine, but this is what it would look like, right? You have your P&L, trade win percentage, all these things connected to your account up there. You have your day view, obviously all these things daily. Your trade view, which shows you all of these data points, which you need. And data collection is very, very important. And then obviously your trade notes here. You go into here and say all these different things as I showed you on the spreadsheet. And then you import the spreadsheet onto here to have kind of an outline. It shows you all your performance, your overview, reports, you compare, and you can have some insights too. You can also do a Zella AI where you can ask it a question. Okay, what is my average risk reward on my trades the past 6 months compared to the previous 6 months? Blah, blah, blah. It'll tell you. And then you can build your own trading strategy. Obviously, you can have shared. And then you have a progress tracker, right? Obviously, this is still the demo account, so it's not done yet. And then you can have trade replay mode, day replay mode, scenario replay, all that stuff. And then more resources like economic calendars. If you want to use TradeZella, use code Dukes when you check out for about 30%. And these are very, very important. And this is something you can use as your journaling platform. Now let's go back to the spreadsheet where I'm going to show you exactly what and why to journal. Okay, so back on the spreadsheet, obviously that was the TradeZella part of it, which you will be importing all this stuff into. Okay, so go into the trade log, right? This is where you would put everything. You would put it inside of one of these spreadsheets if you want to use this or TradeZella. And it'll show you, once you enter all these things, the summary. So it would go into here. And if you want this exact spreadsheet, comment down below or DM me on Instagram, I'll send you it. Like, for example, which entry model are you using and how many wins are you going to have from that? How, what's your P&L, blah, blah, blah. Trades log, wins, losses, break even, win rate, net P&L, average P&L, plan followed. All these things that you need. It's called data collection, right? And with data collection, you understand where the discrepancies are. And that's the most important thing. And that's what I really wanted to get into with this portion of the video. If you do not know what your average risk reward is, if you do not know what your profit factors, if you do not know what your P&L is over the last 30 trades, if you do not know your win rate over the last 100 trades, that is a problem, right? If you haven't taken that many trades, you're not even at that point yet, right? But the most important thing is you have to collect data, just like any other thing, right? Let's go into, why do schools and colleges collect your test scores, collect your SATs, all these things to collect the data. And you see, for example, I'm bad at math, but I'm good at science. Okay, let me go into the math portion and study up on it. It's the same thing with this. You have to treat trading like a business. And if you had a business, you'd get every single data point, right? Your return on ad spend, your, marketing sector, your finances sector, your accounting sector, and you would see what's the discrepancy and fix that discrepancy ASAP because it's a business. You need to make money from this. It's the same thing with trading. Collect the data, execute it, and that is the asset system. That is a part of the systemizing I do with all of my mentees. I completely systemize their trading because that is what is very, very necessary in order to have a profitable outcome, right? Think about it as that. Think about it as a business and go through all of these terms, take everything down, execute it every single day. If you want to use a spreadsheet or TradeZella, get all this data, and I promise you're going to see strides in your trading so much quicker.